Hi guys, welcome back to the Joyful Investors channel. Are you wondering how to invest with a looming recession on the cards? The Fed has been battling against the highest inflation experienced for a long time and has raised the interest rates quickly in an attempt to curb the pace of inflation. This is not helped by the rising energy costs, the ongoing Russia-Ukraine war, the supply chain disruption, and contraction of the US GDP for the first 2 quarters of the year. It all seems that we may well be heading for an impending recession. A 2003 recession has been a consensus view, with probabilities ranging from 60% to as high as 100% among economists surveyed by Bloomberg. So the million-dollar question to us as investors is, in light of a possible recession ahead, should we sell everything now and get out of the markets? So first, what is a recession? It is a period of significant decline in economic activity that may last from months to years. Some experts declare a recession when the country's economy experiences a fall in GDP, rising unemployment rates, and contracting income and manufacturing activity for an extended period of time. Recessions are part of the business economic cycle and are bound to come from time to time. The National Bureau of Economic Research is recognized as the authority to define the start and the end of the US recessions. Interestingly, they have their own set of definitions as to what constitutes a recession. But by and large, the criteria still falls on factors such as real GDP, real income, employment, and industrial production. So let's jump back to the question on how should we prepare for a recession as an investor if it really comes. In short, the effects of the recession is only as important as how it affects the performance of our stock portfolio as an investor. Of course, during a recession, people can be affected by many other things, such as losing their jobs. But let's just keep it to how it affects us as an investor. Prices of stocks in the long run gravitate towards its earnings. Hence, the emphasis is still on whether the companies are going to do well in the years ahead. Let's first look at the broader picture. If we look at how the overall markets have performed, we can see that the US market indices do well over the long term. The reason is that these market indices are an evolving basket of the best performing US companies. Companies that do not perform well will eventually be replaced with companies that are more profitable. Therefore, though recessions happen from time to time, they are just a blip in the grand scheme of things. In fact, the pullback in the prices is a good opportunity to accumulate good stocks for the years to come. Historical data has also shown that in the past few recessions, we can get double-digit returns 12 months after the recession. And when we zoom in on individual companies, companies in certain sectors may also hold up better during a recession. Take a look at the stock performance of the consumer staples sector versus the consumer discretionary, the technology, and also the energy sectors during the last few recessions. We can see that during the 2020 and 2008 recession, the magnitude of the decline for the consumer staples sector is generally smaller compared to the other sectors. Examples of stocks which fall under the consumer staples sector are Coca-Cola, Procter & Gamble. These are the businesses where the demand for essential items and everyday goods usually stays relatively stable. Hence, their earnings and cash flows remain relatively stable during a recession. If we take a look at the financials of Procter & Gamble during the 2020 recession, it still managed to increase its sales and revenue. The operating cash flow also increased in 2020 and 2021. And if we travel back in time to the 2008 recession, though there was a decline in the revenue and earnings, the percentage decline was just a single digit. And that goes the same for the cash flow, which tells us that the financials remained relatively stable even during recession. During such an economy, we can consider having some positions of such stocks in our portfolio to reduce the overall volatility of our investment portfolio. In addition, it's good to pay attention to the debt levels of companies and avoid those with high debt loads that are highly leveraged, as they may not be able to service their debts when lending standards tighten. Now, even if you do not know how to pick the right stocks, by buying into an index ETF such as the SPY ETF and dollar cost average through it, you're going to come out fine eventually. It may sound ironic, but the best time for an investor who does not wish to time the market is to buy when they believe that the markets are going to come crashing down. You would want to buy on your way down to lower your cost instead of buying on the way up. Buying stocks at a lower price will help to increase the chances of maximizing the upside in the future. And to add on, the silver lining is that the stock market is actually not the economy. In fact, the stock market usually moves ahead of the economy. This is because stock markets valuations reflect the expected future earnings. Hence, stock markets are forward-looking. By the time most people sell away their stocks, that could usually be the time when things are going to turn around. These are some examples where the stock market began recovering even before the recession ended. So in investing, as long as we are prepared for the worst case scenario, the upside will take care of itself. So we are not really that concerned if a recession eventually plays out in 2023. And even if it does occur, if you ask us, our guess is that it will not be as bad as what we have seen during the Great Depression or the dot-com burst of the 1990s. Recession can be caused by many reasons, such as a sudden economic shock, excessive debt, asset bubbles, or technological changes. The previous recessions were caused by major economic imbalances, such as the housing bubble and the rapid over-speculation in the US equity valuations. Such imbalances are not prevalent in today's context. Plus the fact that we already have seen significant drawdowns in the stock markets in 2022. So perhaps some of the effects of recession have already been priced in as well. So in short, we don't need to overreact even if a recession really comes. While recessions can sound scary and present some uncertainties, the stock market looks ahead and economic reports are reviews of the past. Every recession eventually turns around and the stock market goes up over the long term. So remain invested if you already are and not be affected by the market noises, which are not relevant to the long-term earnings of the good companies that you hold. With this mindset, you will be able to navigate the markets joyfully in 2023. If you enjoyed this video, do smash on the like and subscribe button. And if you want to stay updated with our investing insights, do join us on our Telegram channel. See you in the next video.